let's look at the accounting equation and how a business's transactions are affected. Let's take a look at an example and see how the transactions of a company affect the accounting equation. You can pause the video and take a minute to read the question, and then we'll continue from there. It says ABC Company was formed on January 1, year 1. So if this was formed on January 1, year 1, this company was just born. Think of it as just being born. There was no company before this date. They want you to show the effect of each transaction on the accounting equation. So they have given you transactions A through H. And then second part says prepare something called a balance sheet on December 31st, year 1. So before we get started, when we are looking at these transactions, whose perspective are we going to be looking at these from? Who are we? We are ABC Company. When were we born? We were born on January 1st, year 1. Now you know the accounting equation is assets equals liabilities plus stockholders' equity. On January 1, year 1, the minute the company was formed, the minute we were born, how much assets did this company have? How much liabilities did this company have? And how much stockholders' equity did this company have? The answer is 0. 0 assets, 0 liabilities, and 0 stockholders' equity. The company didn't exist before that. So right as it was formed, it doesn't have any assets, doesn't have any liabilities, doesn't have any stockholders' equity. That's our starting point. Now let's look at the first transaction. It says ABC received $80,000 cash from issuing common stock. So what does this mean? There was an investor who gave $80,000 in cash to the company, and in exchange we issued a certificate of ownership, and we call those common stock. So let's see how this transaction affected the accounting equation. When we're putting this down, I'm going to actually look at which specific accounts were affected by this transaction. So let me put A here because we're looking at transaction A. So what happened here? The company received $80,000 cash. What type of item is cash? Cash is an asset. So under assets, I'm going to type in cash. What happened to the company's cash? The question says that ABC received $80,000 cash, so our cash went up, our cash increased by $80,000. Before transaction A, the company didn't have any cash, it was just formed. But now we have $80,000 cash. So I'm going to put that $80,000 as a positive number in the cash column. Now, for every transaction that we look at, the accounting equation has always have to be in balance. So in this example, cash increased by $80,000. So now we have assets of $80,000 here, but our liabilities and stockholders' equity are 0. So our accounting equation is not in balance. Something else has to happen to keep this accounting equation in balance. What else happened? Well, we said that we issued common stock certificates for the investor. So now we have common stock. We have $80,000 of common stock that we issued to the investor. What type of item is common stock? You know from before that common stock is a stockholders' equity item. So we're going to go to the column under stockholders' equity and say common stock. What happened to common stock before this transaction? Common stock was 0. Now we have $80,000 of common stock. So common stock increased by $80,000. Now, does our accounting equation balance? Yes, it does. Our total assets are $80,000 and stockholders' equity is $80,000 with no liabilities. Therefore, assets equals liabilities plus stockholders' equity. Now we're done showing how this transaction affected the accounting equation. Let's move on to the next one. Let's get transaction B. Transaction B says ABC Company received $200,000 cash by borrowing money from a creditor. So the company borrowed money. We are the company. We borrowed money. When we borrowed money, we received $200,000 cash. So what happened? Our cash increased by $200,000. So in the cash column, I'm going to put a positive $200,000 to show that my cash increased by $200,000. What else happened? Because the accounting equation always has to be in balance. Well, now the company got into debt. They borrowed money from a creditor. We know that when the company borrows money, it is a liability. Debts are liabilities. And it's a loan. We know that the loan is always going to be called notes payable. That is the only liability account that you know for now. So our notes payable account will be affected by this transaction. The question is, what happened to our notes payable account? Well, before this transaction, we had zero debt, zero note payable. Now we have $200,000 worth. So our notes payable increased by $200,000. That keeps our accounting equation in balance. For this particular transaction B, assets increased by $200,000, liabilities increased by $200,000, nothing happened to equity, keeping this accounting equation in balance. Let's look at the third transaction. Transaction C says ABC Company paid $60,000 to buy land. What happened? The company paid $60,000 to buy land. So we bought land. The company now has land, but they lost $60,000 of their cash because they had to pay that. So let's look at the cash column. Our cash decreased, so I'm going to put that as a negative number, $60,000. And in accounting, I like to use parentheses to show negative numbers because that will help you easily notice that that is a subtraction, that's a decrease. So cash decreased by $60,000, but our accounting equation is still not in balance. What else happened? Well, the company received land. The company bought land. So now they have a new asset called land. So I'm going to have another column that says land. And I'm going to put that 60,000 as land. Now, what happened to our land? Did our land increase or decrease? Our land increased by 60,000. In this transaction, only the asset side of the accounting equation was affected by the transaction. One asset went down, the other asset went up. Liabilities and stockholders' equity was not affected by this transaction. Let's look at the next one. Transaction D. It says ABC Company earned $90,000 by operating a parking lot on the land. So now we're looking at providing a service. We know that whenever a company provides a service or sells goods, we call that revenue. And the company just earned $90,000 worth of revenue, and they received cash for that revenue. So we know that our cash increased. I'm going to put $90,000 cash because I know my cash increased. But what else happened? Well, our revenue increased by $90,000. But how does revenue affect the accounting equation? You know that revenues affect retained earnings. Retained earnings is a stockholders' equity item. So I'm going to put retained earnings here. And I know that retained earnings is increased by revenue. So if my revenue increased, my retained earnings would have increased by $90,000. So I have that here. Now let's make sure the accounting equation balances. Assets increased by $90,000, nothing happened to liabilities. Stockholders' equity increased by $90,000, keeping the accounting equation in balance. Let's look at transaction E. Transaction E says ABC Company paid $68,000 for operating expenses such as salaries, utilities, maintenance, and interest. Now, the company paid $68,000 cash, so money went out, our cash decreased. I'm going to decrease my cash by $68,000. What else happened? Well, we know that operating expenses are expenses. So examples of expenses are salaries, utilities, maintenance, but these are expenses. How does expenses affect the accounting equation? Expenses have the effect of decreasing retained earnings. So if our expenses increased, it causes retained earnings to decrease. If it causes retained earnings to decrease, I'm going to put the 68,000 as a negative number here. Again, if you get confused, please listen to that again. We spoke about how revenues, expenses, and dividends affect retained earnings. Revenues have the effect of increasing retained earnings, and expenses and dividends have the effect of decreasing retained earnings. So in this example, this was an expense. Even though our expenses increased, it had the effect of decreasing retained earnings. So I'm putting this 68,000 expense as a negative number. Is our accounting equation in balance? Yes, it is. Assets decreased by 68,000, retained earnings, or rather common stock, decreased by 68,000. Let's look at the next transaction. Next transaction says ABC Company paid $5,000 cash dividends to its owners. So now the company is giving back some of the profits to the owners. Cash was paid out, so our cash decreased by $5,000. This was for dividends. How does dividends affect the accounting equation? We know that dividends have the effect of decreasing retained earnings. The dividends increased by $5,000, but that has the effect of decreasing retained earnings. So I'm going to go to the retained earnings column and say negative $5,000 for dividends. In your mind, you should make the differentiation. The dividends of the company increased. The dividend was zero before this transaction. After this transaction, the company had $5,000 of dividends. However, that $5,000 has the effect of decreasing retained earnings, and that's why we put that as a negative number there. Let's look at the final transaction, H. It's not even a transaction, is it? It says the land that was bought in transaction C had an appraised market value of $80,000 on December 31st, year one. Here, that's cut off, so let me expand that. December 31st, year one. Let's look at transaction C. In transaction C, we bought land for $60,000. Well, what they're saying is now this land has increased in value to $80,000. So what should we do? We don't do anything because remember the historical cost principle says assets are recorded at the price paid. We recorded the land for $60,000, which is how much we paid to buy that land. But if the value changes, we do not change that value. We don't alter that $60,000. We keep it at cost. So for transaction H, we do not record anything. At this point, let's take a total of all these items. I'm just going to use Excel's feature to total everything. And we'll just make sure that the accounting equation still holds true. I'm going to delete these because there's nothing in these columns. These numbers at the bottom are the totals of the column. So let's write out our accounting equation. What's our total assets? We've got two assets. We have land and cash. Let's look at the total of those two. It would be 237,000 plus 60,000. You add those two, that's your total assets. Your total assets are 297,000. Let's label it assets here. Next, let's look at our liabilities. Liabilities, we only have one account, notes payable. So we know that our liabilities are only 200,000. Next, let's look at stockholders' equity. Stockholders' equity, you have to add your common stock and retained earnings. So let's look at what the total is. It's 80,000 plus 17,000. That's 97,000. So if we write out our accounting equation, you should have 297,000 is equal to 200,000 plus 97,000. Is that correct? Yes, it is. 297. If you add 200 plus 97, you get 297,000. So our accounting equation is in balance at the end of the accounting period, which is end of the year. It was in balance at the beginning because it was 0 equals 0 plus 0. And we made sure that every transaction that we looked at had the accounting equation in balance. So therefore, our ending balance resulted in a balanced accounting equation. That's it for this video. In the next video, I'm going to use these numbers to prepare a balance sheet on December 31st, year 1.